Good evening, friends. I am KK Gupta, your host of this webinar. On behalf of Association of Financial Advisors of India, we extend our heartiest welcome to all the members, bankers, stakeholders, entrepreneurs. Under the series of associations, we are having this 17th webinar. We conducted webinar on the different fields. With the demand from the members, we decided to have this webinar, role of the credit ratings in the bank's loan and debt capital market. We designed the program like this that it should be practical. We are only talking a practical aspects. So that's why we have called from K rating directors, Shri Sharma ji, I think who will be main speaker under the system. So we are also discussing the views of the NBFC, where Shri MD of the Aadhar Housing is there with us, the party sir. We are also discussing the banker viewpoint of view, where Mr. Sinha, DGM of Large Corporate Finance Branch of Bank of Baroda is with us. We are with Deepak Jain, who deal with the capital market. So banker, NBFC and capital market will be eminent speakers, which they may pose the problem faced by them and how it can be mitigated by our learner friends from the K rating. These are the models of the program we are discussing. We have also requested one of the entrepreneurs, Mr. Rajput. I hope that he may join. So we also listen to him as an entrepreneurs, what type of difficulty he is facing to getting the investment grade. Whether you talk about the investment grade or speculative grades. Because the rating, credit rating, done by any credit agencies are playing very important role in decision of the banks lending. Either go to financial institutions or go to the lender or to the investor, they are asking for a rating. Although banks are also doing their own rating, still, if our borrowers is not having investment grade, then banks are electing to accept any proposals, either it may be economical or technical viability will be there. We are also talking about the startup, and we are talking also about the SME sector who started the new venture. When we seeing the basis of the credit rating by the credit rating agencies, we find that 80% marks are considered on the basis of the past track record of the company, past conduct with the banker, past repayment capacity. Because the rating agencies consider the credit worthiness of a party, and bank feel confident if they are having a investment grade. I have got also experience in the fields where if the enterprise entrepreneurs having grade 1, A-rated, double A, triple A. I think rate of interest are being reduced also for that. I will not take much time. So we will interact with each of our panelists who are important in the aspects. We already informed about the speakers. Great experience. When we're talking about Sri Tripathi sir, who worked in a very big bank more than 39 years, now he's heading the MD of the Aadhar Housing, which is a very leading NBFC. Tripathi sir, just I want to know from you about the credit rating. Because you are being NBFC, you must be asking for the credit rating also. Even for your NBFC, if you raise some NCD or something like that, that bank is also asking for the rating. Your company is also having a rating. If you are rating A rated, then bank will welcome. If you are having a not investment grade, so NBFC also finding a problem. They are not getting the money. So I want to know your views and what you are expecting from a credit rating agencies. I hand over to Shri Tripathi sir. Tripathi ji.
Thank you, Gupta ji. Thank you. First of all, thank you for giving an opportunity to be in this webinar. You have already mentioned that credit rating from a registered credit rating agency is one of the very important thing. It is just like that MRI or whole body CT scan of the company.
Sir.
I will analyze in this one word. The rating agency, when they analyze on the various parameters of the company, and they give a very great comfort to the investor, be it bank or be it capital market, anyone else. So I think that is one of the important condition for certain amount of loan beyond you will go. I think Shailendra is there, he will tell that after a certain amount of loan, say 5 crore and above, if you want to go, whether you are SME or any NBFC, you need to have a credit rating. Bankers ask, anybody ask, individual investor when they invest, they also look at that. The rating agencies, various parameters are really very, very well diversified. They don't look into one thing, they look into various things. Now I will talk about what as a NBFC we expect from credit rating agency and what constant we face. I will not talk about only a big size NBFC or a small size NBFC. I will talk NBFC spectrum as a whole. One of things which credit rating agency, because normally they have a model which is very well defined, but one size fit for all model cannot work. If NBFC is starting today a business, it will not be able to fulfill various parameters which a rating agency looks into, except in the parameter like the market potential and the competition. All those things will be available, but things about the particular NBFC will not be available. That is point one. Another point, they look into the capital requirement of a NBFC. A small NBFC may have a small capital, bigger NBFC have a bigger capital. So that is also, there are certain parameters. Well, small size NBFCs, they will not be having, they will not have a vintage of operation, they will not have the huge capital, so various many things they will not be having. My view is that these small NBFCs find it difficult to raise the money from the banking system because of the approach of rating agency to rate them with a one size fit for all formula. I have seen during pandemic, the small HFCs, I am from HFC and NBFC also, they were struggling to get a single penny from the banking system, despite the Reserve Bank of India and government allowed the partial credit guarantee and so many things. They don't have a pool to sell also. The one size fit for all formula doesn't work. Second thing, when they compare the resource mix. That is whether resource mix is diversified or it is from one source. 90% small NBFCs, 90% resources are from the banking system only. And out of banking system also, the predominantly from public sector bank only. So when you ask what is your diversification of resources, where from where they will give, unless they achieve a particular size, they can't give. That's the second point. Third thing, I am telling about my company when I was any other company also. When we were talking the rating agency, why can't you give me AAA? When I am qualifying each and every parameter, why can't you give AAA? The only point with rating agencies, all, not only one, because they have their own limitations. They have to ensure that this company should be able to pay all the times and investors should feel comfortable. This is their predicament. I don't deny that this is wrong. But what happens if you are expecting a microfinance company or a NBFC dealing in a small ticket size of 8, 9, 10 lakhs, its AUM will never reach 50,000 crore. It will take years to get that to reach. If a company is doing 1 crore rupees ticket size loan, a company is doing 10 lakh rupees ticket size loan, the AUM ability to reach X amount of AUM will be completely different in number of years. So my point is that the effectivity of the NBFC in the segment they operate, that plays a very important role than the ticket size. Because if higher ticket size is there, next point comes. If NBFC is operating, most of the NBFCs are operating in the unorganized segment, there they compete, there they support the banking system. In unorganized segment, if you are operating, your collection efficiency will definitely be lower than what the NBFC operating in the formal segment. So if this is also a very not a great comparison. Another point comes, if you ask the rating agency, they will say your portfolio is not seasoned because it is a well-established fact that if the lag NPA of 2 or 3 years is a clear reflection of the NPA. The first 1 or 2 years, the account always behave good. So on the rating agency front or from any investor front, this is a valid decision that your book is not seasoned. But now point comes, if NBFC today is 100 crore rupees, definitely at the low base of the NBFC, their book will become 200 crore rupees in 1 year, then 400 crore. If they will reach about 3,000, 4,000 crore, then their growth will taper down to 20%, 30%. But with a small base, the growth rate has to be higher. That every time the disbursement will constitute 40 to 50% of their business of that year, then the seasoning of portfolio will not be possible to be analyzed properly in 4 or 5 years' time. That is also one of the very important factors. What another thing I wanted to expect about the special situations. What are those? We have seen recently the COVID special situation. During the COVID time, if you expect COVID time and the ILFS issue time, when ILFS issue came, excepting AAA rated NBFCs and HFCs, nobody was getting a single penny fund from the banking system because there were trust deficit due to some misgovernance of few companies. So nobody is to be blamed. But now you tell me, if the rating agency becomes shaky in giving a rating, then the NBFC, HFC will not be able to get support from the banking system. And liquidity crisis is the major reason of failure of a company. Even how extraordinarily we are governed, the liquidity crisis will kill us. So my point is that such situation should be dealt with deviations. They must have in their rating model, they have got a very robust rating model, about 6-8 core parameters they look into. I think a specific situation always requires a deviation model to deal with that. Now, during COVID time, when RBI gave moratorium, when RBI allowed restructuring, naturally the companies which are operating in the low income segment, there the moratorium or restructuring would be definitely higher than the companies, big companies like operating in the formal segment. at that point of situation, the rating agency should look into that what is the restructuring percentage and what is the behavior. At least 1 year time they should give for lowering down the rating. I agree. The first year the rating down was too much was there from the rating agency across the NBFCs and companies. Next year it was upgradation also. I don't say that it was not there, but the special situation require a special dispensation from everybody, and the regulator should give direction for that because they are regulatory agency. They cannot do. And another last point, I will not take much of time. And the last point I will like to say, the regulatory changes. November 12, November 21, the RBI came that all NBFC will have to follow the model of NPA recognition, 90 days past due, and once NPA, always NPA till overdue is recovered. Naturally, this was a complete change in the system the NBFC HFCs are following. So all HFC NBFC have seen the spike in NPA, maybe from 65, 1% or 1.5%. So this requires to be given a non-event by rating agency for this purpose, at least for 1 year, how they are able to adopt and reconcile with the guideline changes to come back to the earlier trend of NPA. If you are immediately seeing that NPA has gone up, your asset quality had deteriorated. No, asset quality remained the same. That account was in 90 days. Because of the regulatory change, it became an NPA. Provisioning cost of credit has not gone up. Nothing has gone up because in Ind AS, the cost of credit is already defined and it is same. It is for 90 days something else, 90 days something else. So in such cases, when it is not going to be abnormality because of the regulatory change, or some 1 month, 1 year, or 1.5 year period for aligning their customer to the new model needs to be given. That is what my point is there. And next thing is that analysis with the peer group. If you are in housing finance company or NBFC, we compare with the peer group and rating agency asks vintage. Unless you have a reasonable vintage, you will not get the upgradation in the rating. They do give, but you have to do a lot of maneuvering with them. One is your huge capital base should be there. Everything is linked together. If they will not give good rating, I will not get interest loan at lower interest rate. If I will not get lower interest rate loan, my profit will not go up. If I increase our business sourcing fast, then also taken as a negative drawback, as a drawback that your growth is very fast. So peer group comparison should be given. The some sort of leeway, 10-15% to be given. Whole idea is that whether the management is competent, market potential is there or not, this company is able to meet its obligation or not, that cannot be compromised. And I will never ask they should compromise. They should take into consideration. But too much of comparison with a non-comparable company doesn't work well. That is what my viewpoint. I will stop here right now, and then I will see the response from the Mr.
Thank you very much, sir. I think you are really very important, valid point. Even triple rated companies also failed one day without anything. So that is not a subject we are going to discuss. The major aspect you are talking about the small NBFCs, which has a capital base is less, something problem will be there. So I will not repeat. I will request the Dinesh Sharma sir. So please give your thoughts for that point raised by Shri Tripathi sir. Have any thoughts on subject, sir?
Yeah, thank you, Gupta ji, for inviting me for this webinar. And thank you, Tripathi ji, for your comments and feedback. I think all those what you have just shared with me, it is all not new because we've been from business side meeting mostly client, 3-4 meetings in a day. So we get to hear from one of our customer every day. So because I was telling my teammates and my boss that we are we are selling a product where we cannot promise the delivery, and we will not be able to beat your expectations. But you are still selling, and that's why we call it a very hardcore sale. Though some people believe that it is a regulated product. So what my say on this is that when we do the rating for any entity, so we have categorized with the peer group, as Sir has also mentioned that during our discussion with or rating agency discussion with Tripathi ji came to know. So we are not comparing, all the entity in one, because it is not that we have industry wise, only we look at one industry and all people in one model. So for mid corporate, we have a different team and different model. For a large corporate, rating agencies are having a different team and different model. And there are so many parameters where which we use for evaluating the credit worthiness of any entity. So when we look at the startup, or when we look at the mid-size or a small size entity, so we always compare with the small size entity in the industries. So which is why when you look at and compare, you will find there is not much of a difference between the rating of such size companies. You will always find say vintage or any other tag is there, or based on the size, if the companies are getting high rated, so we compare with that. So industries, every promoter is also, or most of the promoters vision is to reach at the AAA is always there. And but rating agencies have certain limitations when they do the rating, and it is linked with the objective of the regulator, why they set up the rating agencies, and why this task was given to rating agency to evaluate. Because we are not auditor, we are not giving rating agency as a recommendation for a stock to buy. So ours is basically so that lenders can use it as a one of the tool to decide whether to give loan or not to give, and then what interest rate to be charged. So your question was that rating agencies sometime they look at and give only one reason, that because of the vintage you will not get it, or you are getting it. But when you look at the other side of story, when we are giving any leeway to company with a track record of credit history, so, is it right, or giving a credit, or is leeway to the company which is having a 1 year presence in the market? So there could be two sides of theory, because when we start relaxing the norms for a startup or a new company, as a standalone rating agency we cannot do, because our users of rating is banks and financial institutions and lenders and investors. So they have to come up with a product which will be suitable for such entities, maybe with a little higher interest rate or a different repayment scheme. Then the rating scale or the same scale can apply with a different methodology. As of now, how lending institutions are treating all entities which comes for loan, so they are not categorize it in a larger way. In some way they are. So that's why rating agencies are limited to look at but ultimately we are not evaluating all these entities in one basket only. So I think I have written, because don't because because of the limitation, we cannot implement, because at time we have also suggested regulator that why not you go away with this 90 days, whatever is 90 days period is there with the banker, same can be applied to rating agency also. We have also discussed with the regulator view was that because of fundamental reason, we have given this task to you, that one day 1 rupee is to be considered as a default, because this is the way we can actually sustain bring in sustainability in the capital market. So at number of time aapko to, I think you also maybe remembering that many times rating agencies and all stakeholders have written to SEBI. A lot of promoter have raised this with the regulator, but regulator view was very clear that one day 1 rupee default they cannot get away with. Secondly, when when you see how rating agencies are comparing, rating agencies looking at all the business risk, industries, financial risk, and all the other parameter for each entities. So our process is not very much different for any other institution based on the size. Though only what we do is that we internally we have a mid corporate and small corporate team, execution team. So they execute that, but they may not have a very much different approach because our criteria for one industry will be the same. So for it will be the same for startup also, and it will be the same for the mid corporate and so on. So that this is actually, if you get deep into it, you will realize that it is a requirement, of the market. That's why it has been developed. So
Thank you
that is
very much, Sharma ji. I think we'll come back to you for the aspect. Now, Mr. Rajput is with us.
right.
I think he has some family issue. He has to leave it early. So my request to his entrepreneur, and basically he is chairman of the South Asia group of companies. He also started a new venture. So we should listen to him. What he expect from the rating agency. So, Mr. Rajput.
Uh, Good evening, namaskar, everyone, and thank you, Mr. Gupta, for giving me this opportunity to attend this webinar and to share my views. My being an entrepreneur, I have several questions in my mind, and I'll speak on behalf of the chamber also, which I preside, MSME IPO chambers. Sir, this rating, when everyone knows that the present situation is very critical and it's post-pandemic situation. So the government wanted to help, and everyone wanted that the economy should be back on the track. And keeping those things in mind, the government or the PSUs, the government-owned company, they came up with the discounted 3% bank guarantee, and everywhere they were supporting. So what they have done in the tender, they started not considering the last year's balance sheet. Either they are considering the previous year or else they will consider the new GST. So my question is that what rating agency are doing, to match the same. I mean to say, likewise, it's an advice or suggestion that if the government itself is not, they are considering the last year balance sheet for tenders and all, because they understand there was no business as such. If you see the balance sheet, in fact, the banks are also, they are asking for the last year balance sheet, but it's useless. I mean, when there is no business, there was no balance sheet as such. So the previous years would be considered. So my request and my question is that whether you're considering the previous years only, because last year you should not consider when you're giving the ratings and all.
Thank you.
Sharma ji.
Thank you, Rajput ji. So actually, if I could understand your question properly, you're referring to the requirement of the tender, where
It is not only for tender, it is for the funding, because when we get the tender, we go to the bank,
okay.
So the story is same for the balance sheet. So it is, my question is related to that in nutshell, in general.
So no. In general, rating agencies process is that we have to consider the last year balance sheet. We cannot consider the previous balance sheet. I tell you how. Rating agencies cannot implement to a larger extent their own methodologies. All the methodologies and criteria are based on the guidelines from the regulator. So though you will find some differentiation how we evaluate one particular sector vis-a-vis the other rating agencies in market, but in larger scale, the role of rating agency is not that we cannot we cannot influence government, because we are actually one of the entity which actually follow the regulators guideline. So what we do is time to time we take the feedback from promoters and other stakeholder, and we reach out to regulators and we mention to them. So this is the only process how we can help you. Otherwise, say one-off case, or it is very difficult for us to look at the balance sheet of the previous year. Whenever we do the rating, we at least require the last year balance sheet. So if the year was not, good, industry was also facing issues. So we request the client to take the help of the schemes which is offered by the government of India. All this scheme under that there was a one-time resolution plan scheme was also there, and certain other schemes was also there for hotel industry, hospitality, and other sectors which was facing issues during the COVID time. So such schemes, a lot of schemes based on that we have done the rating. So it was and lot of companies where there was a potential default, but because of the guideline that default will not be recognized in certain category from the regulators, we have not given the default rating. So this to this extent, rating agencies are really helpful, but making what we are saying is that this event itself was a learning event for worldwide regulators, entities, and all. So we are not habitual now. We'll be more habitual every year. We will see COVID like a situation. But regulator to RBI and SEBI to look at all such things, and rather from Ministry of Finance, if there is any, and what they are doing currently is they are bringing in schemes. They are linking some scheme which promoters and entities can use it. All large and mid corporate and small corporates have already utilized those schemes.
Sinha sir, whether you have any view for that? Because the government, while having a tender, they are not considering the last year balance sheet because there is nothing. So, as a banker, what do you feel, sir?
Yeah, good afternoon, everyone. So first of all, thanks, Gupta sir, for giving this opportunity. And whatever I say, it's my personal view. This has nothing to do with my institution, Bank of Baroda. So first of all, I thanks Mr. Dinesh Sharma, his statement that we are selling the product and we don't know whether we are delivering the goods in a time and
meeting the expectations.
I think this fundamental is very good, very, very. I really appreciate it, because unless and until you will not bifurcate both the part, because nowadays today the entire banking sector is dependent on the credit rating. Entire banking sector dependent on the credit rating. So I think I have some different view. In my experience, what are the accounts I am handled here, and this is mostly the infrastructure sector, I observed that during COVID time, most of my clients' rating have been improved. Even in the steel sector, stainless sector, cement sector, okay, EPC contractors, their rating are not improved by 1 is to 2 notch. Triple B company moved to the A-rated company, A-rated moved to double-rated company, and I think except 1 or 2 accounts, because where they have the retail shop. The retail shop, suppose any person have a jewelry shop, suppose any persons have this shoe business, retail store. So that practically that account is really affected due to the lockdown or due to the closure of the shop for the 4 months or 6 months. So rating there has been downgraded by 1 notch. But in the most of the cases, those are involved in infrastructure sector, their rating have been upgraded. Now the second point, I can say this rating agency now, if suppose as an individual, we are very much worried about our credit score. In any case, we don't want to make a single day default so that our rating has been downward. So nowadays, there's a competition among the companies also. They want to maintain their rating or they want to upgrade their rating, because ultimately it's now become a status symbol also. A company having A-rated, sir, he can come to my branch and proudly say, sir, now I am upgraded to double-rated company. And then he started this, whatever the rate of interest, all the things. Sir, I just put an example to you, the importance of credit rating agency, credit rating in the corporate world. The 1st April 2022, it was bank holiday. And I have 3-4 big customers whose installment is due on the 1st April. They remitted fund on 31st March. They don't want to make a single day default. So I can say कि is impose a financial discipline amongst the borrower also. And second thing, sir, this Tripathi sir, because nowadays because I have to classify this MSME sector and the corporate sectors. Okay. Unfortunately, all the banking guidelines or all the rating agencies, they are applying the same parameters for the MSME as well as for the large corporate also. So in the large corporate, they have the expertise. They have the expertise persons who can manage, who can do all the ratings, all the things. But in the MSME, it's a real problem in the MSME sector. Because MSME sector, because I have been experience of working in MSME sector for more than 5 years. And on my personal experience, I can share you, sir, they know how to do the business. I'm talking about the SME borrowers who has having exposure of the 5 crores or 10 crores. They know how to do the business, but they don't know how to manage the paper. They are ready to provide the collateral security. But if you ask the so many fundamentals data, they're unable to provide it. But in that case, in the case of the corporate, whatever the data you will ask, they can immediately submit to you. So that's why the MSME sector to getting rating BBB is the best rating in my view. And I have a very rare occasion. I have seen any MSME customers who is having A rating. So my view is that whenever we have to distinguish between the MSME as well as the corporate sectors.
Feedback well taken, sir.
So, Sinha sir, important aspect you are talking about the SME sector. Lekin my point, which we have discussed morning also, for a startup, even a SME has started the unit. So whether the bank should insist for the rating, investment grade rating. This is the most important aspect. He started. He had no background, no papers, no track record of repayment, nothing else. He come IIT graduate. He's starting the new business for that. Even he had no capital. He want to raise seed money. And banks, whether banks should insist for the rating.
Sir, I think you have touched by the personal point because I have very closely watched this MSME sector.
Sir.
Okay. So unfortunately, we don't have any policy for the startup. First thing. Second thing, in my bank, we do not insist for a startup for credit rating if they have they ask for the loan up to 50 CRs. Above 50 CRs, we are asking for the rating. Now, sir, since you have touched it, because nowadays I have handled 2-3 startup company also. Most of the Indian startup are the IT background. They are techno-savvy. And in India, we don't have any rules or regulations or any banking guidelines or any this policy for the IT sectors. We are still dealing with the tangible sectors, tangible articles. We don't have any the intangibles. So this is a basic difference. Suppose if a bank is funding to any manufacturing sectors. So when we go for the inspection, we say, okay, office is building on, this office is completed, machine is coming on. When we see this tangible assets, we are satisfied. But when you are funding to any IT sector, what is their input? They use maximum amount of the loan for making payment to their staff salary. What they are doing? They are making program in the computer. Is any guidelines, anything is there where we can verify in the software what they are doing? No. So first of all, we have to make some policy for the IT sector.
Sir, for Sinha, what we are talking about, I agree with you. Instead of a assets-based funding, now the concept is coming very fast. Even certain banks also introduce for the cash flow funding, cash mismatch funding. So that concept already come. What you are talking about 50 lakhs rupees and less, you are not asking for the rating. Even up to 2
50
crore
crores, 50
rupees,
crores,
50 crore, you're talking about 50 crore.
50 crores, sir.
Yes. 1 5.
1 5. No, 50.
50.
0 crore, you don't want any rating for that.
Yes,
I
yes.
think this is addition to our knowledge, because when we people are going to any bank, they asking whether rating is there. Either they asking for 5 crore or 10 crore rupees rating aspect. I think your bank is far away. I think you are doing excellent job for that. My only point for the rating to Mr. Sinha, Mr. Sharma is there, because Sharma, when I am seeing your grading and your basis of the calculation score, you can say credit score modeling. So, what is the position is there? About 35% you are talking about the payment history. Then 30% you are asking for the credit utilizations. And 50% is a credit history length. That means totally 80% marks will go for a new entrepreneurs. So whether the rating agency, I think you have done something for the startup. When we are talking about startup, it includes the SME sector also, who want to set up a new unit for that. And having a project report, he is a technologist. If in a fintech company, they are also coming. So what do you feel, Mr. Sharma?
Sir, first of all, would like to correct that we do not have such model where we have the calculation what you just mentioned. What we have is that for each and every industries, we have a different models. So, and criteria for each and every sector is also different. So when you say in a particular a startup in a one sector is we are or any rating agency is providing this kind of scores, he or she may be referring to one of these sector, where you will find some differentiation. Otherwise, each and every sector we have a different criteria for evaluating. Right. So, small HFC, if it is a new startup company and with a 1 year track record and promoter is also from a well-known, background, may fetch an investment grade. But, if you're talking about any other sector where the solar project is just one and there is no PPA sign and all, they may not fetch it, the investment grade. So, for each and every sector there is a different parameter, and when we there is no categorization for startup also in our any model. What we do, we look at the experience. So this is one of the parameter. But when I say one of the parameter, there are actually 65, 70 other parameter. So it is not very significant also. When you say that, okay, there are 10 parameters you evaluate on a rating. So in a many manufacturing sectors, the parameter can go up to the, 70, 80 also. There are a lot of things. But in a few sector, it may be only in a thermal power, it may be 15 parameter, but for a HFC maybe 25 or something. But it is very sector to sector, and and you may require a one-off session for each criteria to understand the industry, because rating agencies, if you must be aware that for each and every case, whether it is a small case or or a larger case, we take around 3 weeks to 5 weeks time to give the rating. And Mr. Sinha agree with me, because his team is also sometimes follow up with us as, boss, why are you taking so much time for the rating? Because we also putting our man-hour basis, we are working, and if you're able to do 3-4 cases in a week time, you will be able to do good chunk of business. We have around our employee base was once touched 600 because of that. Because rating agencies have to look at carefully, that's why. And because of the experience of rating agencies for the last 25 more than 25 years, we able to develop lot of models and methodology to understand the fundamentals. Because we rating agency cannot detect fraud, but we can look at what can go wrong. Another thing, I think I have answered your question, but
Hey, you are, sir, you are right. My only point is the for SME sector. If
hmm,
you started a new venture, so actually all, I'm not talking about the care or somebody else, all credit agency is never hesitant to give them investment grade. Like I'm giving you one example for that also. if their associate and big associate company undertake to give a guarantee, I think they can get a investment grade. So why, sir? My point is very pointed point. If a new company, new entrepreneur is coming in the same trade, he cannot get an investment grade. If some associate company or some other company give a guarantee, then you say it is an investment grade.
I tell you why, because
Why?
this.
I understood. I understood because you want their bank security. Like bank for rating agency, there is security is nothing. It is only a question of their credit worthiness of the, and you are giving a credit, not a company. You are giving a rating to a product.
Correct.
You are having a cash credit limit. You are having a term loan limit. You are giving a rating to that product. You are not giving a rating to the company. If I'm corrected, if I am wrong.
Correct.
So then why you are distinguishing between the two things?
What we do is, sir, we don't look at the intention to pay. We look at the ability to pay. When we understand this word, because as a rating agency, we cannot.
My only point is when you are getting a guarantee, you're saying, okay, the associate company stand as a guarantor. So you say, okay, investment grade. If you know, if so new company is there,
I tell you
I'm not giving anything. I understood your viewpoint. Lekin that I think should be looked into the proper way.
No, actually, one explanation is required, because this guarantee is given to the bank. This is the shortfall undertaking or
yes.
guarantee. Right?
Now I am more clear.
Yes.
SME sector has started a unit, but here nothing. So you will say, no, it is not an investment grade. If that company is having another company, big company, so if I will say you give a corporate guarantee of this, then I say it is an investment grade.
Right. So what happened? The SEBI also was curious that at your point, and regulator said that company defaulting or not able to generate cash, you are giving the A rating or a higher rating, and then another entity which is actually not very generating cash, and you're giving a low rating because of the parentage. So what they ask us may not be because of this reason, but I'm just giving an example. They ask us to mention the non-supported rating also in the rating letter nowadays. So for last couple of years, we are mentioning the corporate guaranteed rating and also the non-supported rating. So we'll find two ratings there. And in case of government, you will find that in one case we are giving a default rating, long back I'm talking about, and another we are also giving a rating because of the government, state government. It is a AA rating or a A rating. Because government is actually, feeding to the bank every month their EMI, and they have taken the guarantee. So there is no probability of default.
My only submissions to you for this point. So, Chinaji, you want to say something on that subject?
Yeah. I think
relating to the banking sector.
I think you raised very good question. Suppose if any new company this start a venture and he has support from his parent company, or parent company is ready to give the letter of comfort or guarantee, so rating is immediately improved to the A rating, investment grade. That's it true.
What is your view in that respect? I'm asking.
View that yes, to some extent, bankers also need some type of the comfort, and that comfort may be provided by the this letter comfort by the parent company. Now the second question is the startup company, sir. So I have just one request, Mr. Dinesh Sharma sir, when we do rating for any startup company or any startup who has their technology sites or IT sector. So if you see what is the strength of this startup? What is the strength of the promoters? If we see the strength of promoters is educational background. Most of the nowadays startups, they have very good background, educational background. They maybe come from the IIT and IIM. So they left the job of the crores rupees jobs and they want to set up their company. So why not we consider their educational background as a part of the quality security? Yes, as part of the rating. When we have educational loan policy, we distinguish. Okay, you are studying in the IIT, so your loan amount should be this much. If you are going abroad for Cambridge, your loan amount is 40 lakhs. If you're this institute, your loan is so why not we take their educational background as a part of the rating?
So it's education.
That is their strength.
Yeah, this education background, what you said is rightly, it is already a part of that evaluation. Only thing is that it is not very significant in
It is
any criteria. So because it is a part, because when we do the rating, I was telling similar to in the morning also to someone who was actually there was a discussion with one of the person in the hotel sector. He said that I make 40% EBITDA and my turnover is 100 crore. So, and why are you not giving me, double A rating? Just look at that. So I was telling him that was the, financial criteria is only 50-60% or maybe less than that. For us to give a rating, we look at a lot of things. There are promoters who are actually, may have some weird background, but their companies are doing well. So we cannot give, a category rating because there is a history. So I'm talking about all the rating agencies' view here. So that's why. So
In
what?
new companies, sir, where the history will come, sir?
Huh?
In the new startup, suppose a new entrepreneur who just come out from the college and he just say develop a beautiful idea and concept and he want to start this business. So his background is his promoter's background only.
We have done it. We have done in one of the project recently. I mean, I'm just giving a recent example, but it is a norm. So it is a new plant, set up by a startup with no background, only education, that he understands the sector, and he may have worked indirectly with the sector. So we have considered that because there was nothing to consider, as you rightly said. So the entity got very good rating because of this only, that promoter is having the education, good education background and understanding of their sector. Because if you don't have anything and proposal come to us for rating, so what we look at, he's saying that I don't have any track record and this is my IM which is recently made, and I have applied GST and all these things are under process, and this is my project, and I have this DPR ready, and then after 2 years I'll be generating cash, and now this is I'm funding through my equity. So you do the rating for me. So when we doing it, we found that okay, company can easily pay till the project is commissioned. So so that way rating agencies are carefully looking at, see, we both are having the same objective, and I would say that all three of us, the stakeholder, the lending institutions, rating agencies, and also borrower, it's the same objective. We go. Only thing is that we are all doing our duty. So we have to carefully evaluate. There are 10,000 ratings. Each rating agencies are doing it, larger ones. And if and default rates are actually now in thankfully in 1%. CDR rate I'm saying, but otherwise in sometime it fluctuate, and it is not good for the industry. So that's why we have to, and one more point you have mentioned, I want to say that the nowadays we are looking at the credit scores of each of one of us, and I must say that now it is very difficult for anyone to apply for a credit card if his credit history is very bad, even the farmer, right? And but the same thing will come for rating agencies also. In time will tell. After 5 years or 6 years or maybe 10 years down the line, every entity will have a rating. Still, you will find thousands of companies are not rated because of intentionally or not. Because of some reasons, it is not rated. But time will tell. After 9, 10, or maybe so after, you will see every company coming to you will have a credit score. My role will be minimal, I think, because all rating is done, and you will have the software where you will be looking at the rating directly. You will not be approaching me. So that time will also be coming.
Very great, Sharma ji. I think you envisage very rightly.
Sir, हमारा काम
Like
कम हो जाता
just like a credit
या
score,
बढ़ जाएगा वो,
definitely you will have this rating. Everybody can go and see on the website
right?
only. Now I'm coming to Deepak Jain. He is a chief executive, Growth North Capital. He is having a more than 16-year experience. He is also ex-banker of Standard Chartered Bank and Edelweiss Financial Services. So he is looking after capital market advisor for that. So, Mr. Jain, what do you feel as a capital advisor, as a NCD or you can talk about bond. How you feel that rating? You find some difficulty in rating, or it is okay? If you find any problem for that rating, and what is your suggestion for that? Hand over to Mr. Jain.
Thank you, Mr. Gupta, and good evening, everyone. Uh, First of all, I like to say that capital market itself is a very highly capital market itself is yeah capital market itself is a very highly regulated space. So anybody who is accessing the capital markets, whether it is for debt or equity, both the instruments and allied instruments are fairly covered by SEBI. So even in the capital market, debt capital market side, there are multiple products which now are being accessed by corporates. Now, rating itself is a challenge to get a triple B rating, and for NCD issuance, investment grade is mandatory. So that is why you would see that the bond market in India is highly polarized. Over the last 5-7 years, the investors have basically realized that there is a long drawn legal process if anything goes wrong in terms of recovery of their dues. So 98% of the trade flow business is happening in only AA negatives. In fact, AA negative is actually a mandatory criteria now with most of the mutual funds. And if any deviation is that, they have to go to the board. So the market has become very polarized. Now, in terms of startups or in terms of even mid corporates, I would, since Mr. Gupta was harping a lot, I would like to give some numbers. In India, there are roughly 17 lakh registered, and out of that, only around 6,000-7,000 companies are having turnover in excess of 5,000 crore. There are close to 23,000 companies which have turnover in the range of 100 to 1,000 crores. Okay, now this is the set of the companies. Even if we remove the companies which are less than 100 crores, this 100 to 1,000 crore company are the company that we need to attend to in terms of making them credit enabled. Now, if we have to make them credit enabled, apart from bank, now almost 50% of the funding in India, credit in India is done by banks, and in that too predominantly public sector banks. Now, if these companies have to access capital market, then the rating institute has to play a larger role in educating these clients also. Today, what I feel is that rating business is a high impact, low engagement business. As you said, it is marginal, and this is what I've seen across rating agencies, that when you go to a mid-market companies, they see it as a requirement and a burden, and you see as an opportunity just for commercial reasons. But the long drawn essence of rating and how it is going to benefit, that nobody is educating these SMEs or small mid-sized companies, that how they can get the rating, and also more importantly, how prudent book management, which Mr. Sinha had also told earlier, that they don't know how to manage the books. Now, there are small examples which can be taught to them as to how working capital management in the last quarter of the year, prudent working capital management, reduction of debtors, lower debt, use of non-fund based credit limits, all this can make the balance sheet much better and probably can improve the rating by one notch. But unfortunately, that is not happening, and somebody has to develop time, effort, energy, and capital in having a manforce which can educate these SMEs. Long-term story. Now, in terms of if I had to look at the prevalent debt capital markets, apart from the debt flow business, which I just told you, which is almost 98% AA, there is a strong growth in the structured space, which is covered bond, MLD, and normal bond. Now, in these cases, where rating agencies can genuinely help is by making the credit underwriting process a little more transparent. For example, today in a covered bond, the credit enhancement is given by the extra pool or extra collateralization. Now there, how the respective credit agency is evaluating that extra pool is kind of a black box. Till the time you get the rating, you don't know what it is. And there are very, very few houses here in India which have successfully delivered that. So there, probably if it is a little more transparent and the companies, treasuries themselves can issue these bonds, that is when the market itself will expand. And debt capital market will have to be a joint effort if that market has to be developed in India. It cannot be shouldered singly by a rating agency. It has to be a joint effort by regulators, rating agency, everybody. How this market can be broadened.
So, Jansa, what do you feel for a NCD or bond? Rating is important aspect.
So rating is not only important; it is mandatory actually. And what we faced during the TLTRO and PCG schemes was that the clients struggled to get ratings and also to get the ratings timely, because it was the schemes had a limited time shelf. And that is where I felt that the rating agencies could have been more proactive, because these were clients which predominantly had only classical working capital or term loan rating. It is the first time that most of these smaller MFIs, NBFCs access the bond market through PCG or TLTRO scheme.
TLTR, what you're talking about TLTRO, I think in the first batch, only if having a double A rated company,
Correct.
we availed it. Not for the NBFC, a small rated company, they could not get it. Again, the government has to come out another scheme.
Second TLTRO.
Yes.
Second TLTRO. It was
Because
not taken.
they will have to come another scheme for that. So, what is your suggestion? What you are asking from Dinesh Sharma, sir? Any difficulty you find out for rating?
Sir, a lot of the companies actually failed to get the schemes because they could not get the rating. And
what is your suggestion? What is your suggestion? What is problem you envisage?
Sir, I feel if a company is rated by a rating agency, the rating a bond for that company should not be that difficult. It should be done in a timely manner, and because it is at the end of the day, it is the same credit, whether you are rating a term loan or you are rating instrument, NCD instrument, the underlying balance sheet is the same. So why the delay?
Oh, very nice. Very
I
nice.
think the right.
Somebody, you want to say something, Sharma sir?
Yeah, I think he's right, because when government is giving a small window, rating should be done, or all the formalities should be done in that timeline. Only then only he will get the benefit. From our side, I can only talk about our role, because we carefully look at all these things, because once the client already rated by a rating agency like us or anybody, we should not be taking much of a time. Actually, it is not, because but it depends whether you are doing the annual review that time or not, because once in a year you have to do a detailed annual review, which takes sufficient time. If it is not done and TLTRO came, then rating agency may have to do the annual review, because it is required. But annual review is done in the last 5 to 6 months, already taken up, then it should not be taking much of a time. So timeline is to be respected. And because rating agencies, when they are doing the capital market instrument, the timelines are very, very strict. When we do the rating for any bond or NCDs, the timeline sometimes we have delivered in 2 days time also. Though it was a bank, but I'm saying that a rating agency have to act like that, because though it is the usage of the rating is not the borrower, the lenders, but still you have to respect, because they are paying it for the fee, services. So this is really required and critical. And in the past 1 or 2 years, the rating agencies also facing skill set issues, in terms of wage inflation, because a lot of people are required this by the industry, but people are leaving because financial industry is in demand these days. So maybe because of that reason, some of the rating agencies were facing issues. But I think this is very critical because when you issue bond, you have set one pricing, and then you want that result in a short time only. You have to launch it. Otherwise, the whole purpose will be gone.
Yeah, right. Very nice, very nice. Is
One
there
more
anything
point,
Jan Sam would like to say? Jan Sam?
Yeah, one more point, Dineshji, what I want to mention is over the last 4-5 years, investors have formed their own opinion about the certain ratings issued by certain rating agency. So we have situations where, with the same rating, two different companies, they would trade at a different spreads or different yields. Now, minor difference here and there is okay, but if there is a huge difference that investors are forming about certain rating agencies, what is it that you are, because ultimately at the end of the day, suddenly some rating agencies may be found falling short of some expectation, and ultimately the clients will suffer or the
Right.
investors will suffer. So this divide that is getting broader in the industry, what is your take on that?
See, because of this reason only, regulator ask all the rating agency to publish their default rates on their website and disclose that how many of your AAA or AA category rating have been defaulted, or in each segment you have to provide the CDR rate. Based on that, if it is a wise investor, is carefully looking at that. Based on that only he will be selecting and giving scores. And my experience is that all the topmost rating agency, three or four, sometime three, sometime four, you will not find much of a difference. But if there is any issuances from the other rating agency which come up in the last 10 years or so, so then only you will find a much of a difference. Otherwise, in the topmost rating agency, there are not. That's why a regulator is also not very serious on that, because but in a turbulence time, any crisis, or we have seen couple of years back, maybe for a couple of months that case was there, for some rating agency were facing issues because of that, CDR was impacted. But that has been taken care by all the topmost three rating agency already. And wherever it has not been taken care, regulator is penalizing, or writing to these entities to correct that. So regulator is very, very careful. Every month or so, they are doing audit, and they are looking at the CDR number very, very carefully.
Sir, one more point is a general question. Can the rating agency play any role in imbibing or building investor confidence in little lower rated companies like A or A plus? Because what has happened is somehow investors have lost confidence, and that is why they've got completely, what was my first point, completely towards AA and plus. So what rating agency can do here in terms of strengthening investor confidence?
See, this is a valid point, because not only rating agency, all stakeholders to do this, and already some step taken by RBI. I think there was a circular that the guideline was to bank that all the large portfolio, at least they have to look at 25% from the capital market, uh, and 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 uh, and uh, and because of investors for AA categories, normally if you see institutional investors are only pension funds and regulatory funds and all. So they have their own investment committees, which some of the committees having some view that why not investing in A category also, because there you may fetch a higher rating. So there was a discussion going on, and rating agencies view also taken by them. And there are another body, association of say infra or any other sector. So they were also talking that instead of besides rating, why not look at the probability of default and provide a rating of expected loss. and based on that you price your instrument and investment. So there also a lot of work is going on, and we may see some result in a year or so. But certainly rating agencies is playing significant role here, because if we do that, our market will increase. Right now, Indian capital market is not comparable to India also, because look at the size of Indian market, and we should have a mature capital market now. Though it is mature, but it is very small compared to any other. We are not comparing with the developed countries, but still, Indian capital market required to grow. So a lot of and rating agency definitely can play a good role. We do educating the investors, and on this parameter also, we are helping them how they can implement you know investment, how they can change their investment policy by bringing in another riders for risk.
Very nice, Sharmaji. I think capital market now has to play a very important role.
Right.
Because our in India, capital market is very, very, you can say, small. So
Very
there are
small.
so many questions, 2, 3, which is important question. This is Jagger is asking, except for mismanagement failure is not seen by rating agency in small NBFC, even though they operate mostly in the local market in unorganized sector. Why the rating agency compare with those operates in organized business? I think this is a major point which I think third parties have also raised this issue. So have any view, Sharmaji, on that aspect?
No, see, there are criteria for evaluating the NBFCs. One of the criteria said that they have to, if they want to increase their size, they have to increase, their geographies areas also. So concentration risk and other factor also play a very, significant role. To certain extent, if there is an investment, bankers are also comfortable, rating agencies are also comfortable. But if they are increasing the size, and they want to grow, so they have to grow at a scale. So requirement, in some of the parameter, it's there, and there are a lot of differentiation of opinion. It will be there, but what to do, because they have to, if they have to grow, they have to
The
show.
point, Sharmaji, point is not that. Point is unorganized sector versus a organized sector. A NBFC is working in an unorganized sector. It's a small place, rural place, and one NBFC is working in a urban place. You cannot compare that NBFC with the unorganized sector.
No,
Yes.
that whatever the point he's referring, then we have to see case by case. Maybe it is that.
Yes, you are
It is
right.
not the industry,
Yes, yes. Of
practice.
the industry, the NBS, this I think rating agencies.
Definitely, unorganized sector
Yes,
will not fetch
we should not catch that. I agree with that. Then
Mm.
one another question, Sharma sir, is a Mukund Rajan to enable assess the finance by SME so that our country ease of doing business rank improve. What is assistance given by credit rating agencies? Oh, same thing. What we are asking by SME sector, how much you are helping as a credit rating. I think that is a different model. As per the regulator, you are helping them. Even SME sector, you are having some soft corner. What do you
Yeah,
want to
see,
say, Sharma?
rating agencies set up one separate unit long back, around I think 10
Yes,
years
yes,
back,
yes.
SME ratings business,
Right.
because NSIC was issuing subsidies for the rating. There was an intent from ministry that all the SME should get rating from rating agencies, and the fee for that will be funded by the NSIC. So because of that, we able to do very small companies rating where balance sheet was not prepared or some, and we helped them how to prepare that. We issued that NSIC SME rating certificate also to them. That kind of moment, I mean, which was there long back from government, was really good for the MSME SME sector. Because of that, a lot of company came across rating, and though it was a loss to so many rating agency, because we incurred internally a cost when we do one particular rating, so we were not able to justify, but still, because it was a government initiative, we had to do it. And we did, I think, 8,000, 7,000 companies every year we used to do it, and 1 year we have touched, I think, more than 22,000. So a lot of companies, was rated in that period. And now that subsidy is not there, but still there is an intent from a lot of SME, though requirement of rating is also not there. Mr. Sinha said in many bank, less than 50 crore, you may not require a rating. But still these people are coming to us because they believe that banker will give some, good interest rate if the rating is already, rating is in place. So, so with this intent, they are coming to us. So we are still
Very,
doing it.
very nice.
SME rating also. So
Mr.
that way we
Raghav,
can help.
sir, Sharmaji, Raghav Gupta is raising one important issue. What we are talking about, the most credit score are based on the past history, which we are talking about. We need heuristic value model based on the cash flow and hereby supported with the reliable data. I think he is raising the same question instead of a past history. Why we should not go for future?
No, actually, it is not, it a partly, half statement, because rating agencies are looking at, forward, because we have to look at in the next 2 to 3 years whether company will be able to repay their debt or not. So it is a very much forward-looking exercise. But when we look at the we look at the experience also. If there is no experience, then we look at the background of the promoter, and other factors are also there. So it is not that we are putting a lot of efforts on the past history, but if there is a history, and if but history will not be neglected unless it is a, you know you know it has no relevance. Otherwise it will be, because whenever rating agencies or any bank or anybody is taking a investment lending decision, he will look at the past history. Credit score maybe aap dekhte ho, then rating maybe we have to look at it, but not to the extent that will put 70%, 60% will rely on the history. It's not that.
Then one question from Dinesh Kumar is there. I think I could not understand. I have a credit rating issue with HDFC Bank in respect of credit card. I think for credit card,
No, he's referring to the individual rating, which is CIBIL score.
This is CIBIL score. No, it cannot be credit rating from the, you can say, from the rating agencies. It must be CIBIL score. I think he should take up the bank, or he can take up the CIBIL. Instead, rating agency has nothing to do with this. So another issue is some point raised Mr. Sinha, Mr. S.C. Agarwal. He is asking, required a loan of 1.50 lakhs by an individual to set up a 3 kilowatt RT roof his house to generate electricity for self-consumption. Whether rating is required.
No, this is also, he is also referring to the individual rating, which is
rating. I think there is no question of the rating. First, CIBIL rating is required for that. They will see the CIBIL scoring. You cannot rating CIBIL scoring. I think the most of point. I think this is today was a very, very important interactions. I think so. Sharma ji also pitched very well. All boxer is coming to him. So look at it very nicely.
It's good to hear from all the stakeholders. Yes. You are all stakeholders of the industry. So
you have played very well. I think all boundary sixer. We must appreciate you and your knowledgeable person. So lastly, I am coming to Shri Tripathi sir. Tripathi sir, have your any view, your can say advice to our members, sir, in respect of a rating or something like that, sir? Tripathi sir.
I will advise all the members, rating agency model, all the parameters which they look, it is one of the very important tool to all corporates, SMEs, NBFC, everybody, to consistently improve upon those areas which can enable them upgrade in rating. In fact, when I was in the bank, I used to tell my customers that these are the credit rating parameters of the bank. If you improve certain parameters, your rating will go up, your interest rate will come down. So but one thing which is required from the rating agency side, they should, I think Deepak also mentioned, somebody has raised the question also, any huge awareness is required from the rating agency side. They do only marketing with the big NBFC, HFCs, with the big client. they should organize similar workshop to tell the users how they can improve their rating. That is more important. That is what my submission from the business point of view of rating agencies and from the user point of view also. And which one point I think many questions also come and I also raised that, and you also raised the same point that the promoters' comfort is always considered as a great comfort. Then the entity is its own strength. If the entity has a huge repaying capacity and the consistent track record is good, then if the promoter comfort is a good promoter is there, they give it 1+ notch higher rating. If the no promoter is there, company is managed by the professionals, they will not give the good rating. That is not good. My submission is that. Yeah, I give example. Group Finance was given AAA rating in its earlier time, at a much lower AUM size, because the parentage was great. There are many companies which have similar track record, or the better track record. They were not given AAA rating even for years together. And that brings the disparity among the companies. One gets 1.5% lower interest rate from the lenders, other gets 1.5% higher interest. And same thing was Deepak mentioned with regard to TRRTO. Reserve Bank of India brought the policy that this much amount is allocated for the lower microfinance and NBFC. Even then, that portion was not utilized because the rating was not given to those poor small companies and they could not get the benefit. So my submission, it is not an individual problem, neither rating agencies nor us. I think the government, the RBI, the regulator, SEBI, they all have to look into this. And then the entire problem can become, because everybody is now becoming evolving and making themselves more investor friendly, more business friendly. So my request is not only Dinesh Sharma ji can do alone. He has replied all the questions very well. He has limitations. We have limitations. The entire ecosystem should get evolved more business friendly.
Very nice, sir. Sinha sir, you want to say something, sir? Sinha sir.
I think sir has covered all the point. Okay, and that's a very true key. If a company have some parental background, they are getting the better rating. Even it's a new company also, and AUM size is very small, and they face the better rate from the market rather than the banks. So I think that's a very valid point. I don't know what is the right answer or wrong answer. So let the time.
The answer is very clear, sir, because you can say creditworthiness judged with as an associate company. Accordingly, their risk factor reduced it. I think this is a major aspect because they have some help from their associate company. That's why they are feeling it. The chances of failure is very, very less. That's why they are upgrading the rating. Otherwise, there's no issue.
So in that case, sir, sometimes we have to do two ratings. We have to do the rating of the entity, and if they are getting the corporate guarantee, we have to do the rating of the parent if it is not rated already.
You're right. You're right. I agree with you.
Because risk is taken care by the parent. So So
Deepak Jain sir, you want to say something, sir?
Sir, it's such a nice thing to know that everybody is talking about the SME sector, and I think we will have to thank our current government, which is doing so much of effort in fostering a healthy environment for SMEs to grow. We are having almost 15,000 new company registrations on a monthly basis. Now, this is where I think rating agencies will have to be probably a little more innovative, nudge the regulator if required, because we are getting whole lot of startups, and in this startup culture, if rating agencies don't get up, somebody else will do the funding. There are fintech startups which are coming up, which are already evolving with their own credit models. They don't even look for the rating. So they only look at the credit scores from the individuals. So somewhere rating agencies will have to evolve to inculcate these startups into the ecosystem, and that has to be fast.
Very nice answer. So Mr. Rajput is available. Rajput sir.
Yes, sir, I am here.
You can say something, sir.
It's basically, unfortunately, as my wife has
I
just
know
gone
that's
through
nice.
the surgery,
That's why I'm
so
not asking
in
you
between,
that, giving you much trouble for that.
yeah.
So still,
I'm
you
still in
want to say
hospital,
something?
but
You are
as I wanted to ask, initially I put some question. The question is still there in my mind that, when I asked the question that it should be considered the previous year balance sheet and all, it was very diplomatically and tactfully that question was jumped out and it was not answered properly. Let me tell you one thing, sir. Uh, when when we talk about startup, of course, the startup which has been started by one or two or maybe a bunch of people, whereas the traditional business which is employing more than crores of people, a large number of people, that is basically an MSME industry. And the MSME industry, if you're not going to help them to hold their hand, it is the targeted audience of all the banks also. It is the backbone of the economy and the government of India's tax collection, as well as it is, serving the employment to huge number of people and, controlling the balancing the socio-economic ratio and controlling the crime or whatever you can say, employing a lot of people. So those MSMEs would be the first target and the prima focus. And honestly speaking, see, when it's not like that this industry suffered a lot and that industry suffered less, except hospitals, pharmaceutical company, and this petrol pumps. Other than that, and this entertainment, which is I'm talking about satellite cables,
Infra
all
also.
industries have faced the problem and reason because they were not allowed to work. Even if they wanted to run there, so they were not allowed to work because it was a forced.
very nice, Rajput sir. I am just telling to our eminent speakers and other the listeners that he got a very big contract for NGC. So he could not get the money from the financial institutions. What he had done it, he has arranged for the investor. So although his profit has come down, like he executed the contract. I think the new concept he's come out, and he's successfully done that contract. So thank you, Rajput sir. So lastly, I'm coming to
Sorry,
Dinesh.
sir, I got disconnected. Can I complete my question, please?
Please, you are not there. That's why, because your wife was not there, Mega. You must have that because you are in hospital. So
Network,
I don't
yeah,
want to
network
touch you
issue.
further, sir. हाँ,
सर मैं ऐसा कह रहा था कि ये जो MSME को है, जी सर, I'm sorry. तो ये टारगेटेड ऑडियंस है सब, और अभी तक बैंक्स ने जितना भी फंडिंग किया है और बैंक्स जो बड़े हुए हैं वो MSME के सपोर्ट से हुए हैं, क्योंकि मैं किसी को टारगेट नहीं कर रहा, बट ऑनेस्टली स्पीकिंग, if you're putting money with very big client at one place and when you lose it, you lose it, in a large percentage, whereas if you distribute the money between the MSME, your money is safe and that is how the business grows and the bank grows. तो सर उनको रेटिंग देने के लिए रेटिंग एजेंसीज को they surely must think about it, because there is a number of people who can pay and they are the targeted client, क्योंकि एक सिंगल कंपनी के रेटिंग देने से तो कंपनी नहीं चलेगी ना, उनके पास नंबर ऑफ जो है वो MSME में. So I just request the rating agency company to look into that also particularly and to work out something. Last year
Shri Rajput ji, आपका connection हो जाता. I think your viewpoint has been taken by.
I think we if you understand.
Lastly, you can give your last viewpoint for that. Sharma ji.
हाँ, I think.
I'm sorry sir, आप आंसर ही कर दीजिए क्योंकि मैं डिस्कनेक्ट हो जा रहा हूँ बार-बार.
हाँ, ठीक है सर. Okay sir. Thank you. हाँ, शर्मा सर, बताइए.
I think all the feedback is well taken, and it is a good session for us also, for a rating agency also, to understand. There is a concern because there is a requirement of rating is also spreading. There is a concern on that rating also from the smaller entities, NSIC, SME companies also there. And another thing, what we are doing is that we are working closely with on a regional basis with banks. So wherever banks is, organizing an event where they are asking their prospective customers for interaction, so we are having one session with them on the rating industry. Rating, how the rating is done, and what is the relevant of the rating. So that also we are working closely with the regional banks, offices, and also in a tier 2 cities and all, very proactively. So this is the way Deepak point is taken, that we are actually educating a lot of investors, and this is our duty, to educate the investors on the rating, and also making awareness about the concept. So all the points are well taken. So let us work together, and we are open for the feedback. Don't wait for this session. Also, maybe you can call me if you need any help or any answers.
Very nice, very nice. We are actually last. We are thankful to all my eminent panelists.
Right.
Mr. Bhatti sir, who is always obliging us. Whenever short notice, we are requesting him. So he obliged, and even all the members appreciate his presence. I think he attended so many webinars. Even feedback was excellent for Tripathi sir. He is a very knowledgeable man. So we have no word to express my gratitude on behalf of the association and my personal behalf. And Deepak Jain, I have nothing to say because I met him only on holiday. I think day before yesterday I met him. So when I listened to him and his viewpoint, so I'm requesting him whether he should can join it. So he gladly accepted. I think without any notice, he is with us, and he has an excellent viewpoint for the capital market. I'm thankful to Mr. Jain and Shailesh Sinha sir. You are a very knowledgeable person, sir, regarding a banking sector. Whatever viewpoint you have given to the rating agency, I think that we will look into. We will also try it. If some rating agency or a regulator, we have to approach the SEBI or somebody, so we will try to do something for that also. I have no word to express for Dinesh Sharma. I think he is the person, only one man, and we are having a four bowler. And one person who is playing very, very fast wicket, and he bored everybody. So thank you, Sharma sir.
Thank you, guys.
I think you have excellent, knowledgeable person for rating agency.
No, I really respect Tripathi ji's word, and
Yes, sir.
Deepak, suggestions, and Sinha Saab. So हम लोग मिलेंगे ही. So really, I think it's a good session and learning for us.
Thank you, Mr. Sharma ji, for your. Lastly, I request, Mr. Rohan, you can show our banner of the association where they can have a registration if any members are interested to become the members, because this association formed with the main objective that how we can help the financial advisor to have a recognition by the platform, by the government of India and IBA also. That we are trying to do for the association of the financial advisors. So Rohan, you can show that banner, possible registration, something. Okay, then what we are here for the Research in India, also on behalf of the Research in India, who is a merchant banker, investment banker. We are doing technical viability study. We are insolvency. All field of the financial services, we are there as a Research in India. On behalf of Research in India, I am also thankful to all the panelists and above all the participants. I think more than 400 participants were there, beside the YouTube and Facebook. I'm thankful to participants also who always oblige us and give us a important feedbacks to us. And I request all the participants if they can give your feedback so that it can be useful for us in our future program also. So I think I overset by 35 minutes because all my sessions are being set by 30 minutes. So I am taking 1 hour, like it used to be closed by 1:30. So I'm thankful to all the eminent speakers, to everybody. With this word, I close this session. Thank you very much. I'm really obliged.
Thank you so much.
Thank you, sir. Thank you.
Thank
Thank you, Gupta ji. Thank you, Tripathi ji. Thank you, Deepak.
Thank you all.
Thank you, Sinha.
Thank you.
Thank you.
Thank you very much. Thank you.
Thank you. Thank you very much. Thank you, Rohan.
Thank you, everyone. Thank you.